In this episode, we are going to look at 3 trending stocks that might do really well for 2024. Now, trending stocks have to be in a favorable sector, they have to have good fundamentals, and they have to have enough growth triggers. So let's look at these 3 companies and see what these growth triggers are, and stay till the end because we're going to show you something really interesting. So let's get into it without wasting any more time. So the first company that we're looking at is Zomato. Now, Zomato is trading at 1,60,000 crore market cap. Stock P is not visible here, but it is extremely high because it has just started making revenue now and it is making profit now. And if you look at the stock price has been in a very good upward channel, which is looking really well from a stock perspective. This is usually attributed to companies where there is good demand, there is favorable growth that is coming in, and there is no negative signs on the horizon. Obviously anything can happen at this point, but from as of now it looks good. Now, why is Zomato doing well? So let's look at some growth triggers and key triggers, right? Now, if you look at their food delivery business, the gross order value of the food delivery business that we all used to order is up approximately 29% year on year. That means a lot of people are still ordering a lot more than they were last year on Zomato and Swiggy. So Zomato obviously is doing really well with respect to that, and the monthly transaction users or the monthly transacting users have gone up by almost 8%, which is definitely giving them a very good margin advantage as well. The food delivery business, they're targeting approximately 4 to 5 adjusted EBITDA margins in the near term by balancing growth and profitability, right? So this is something that is doing really well. Now, another business that is doing extremely well, phenomenal for all these companies, is something known as quick commerce or Q-commerce. Now, quick commerce is basically your Swiggy, Instamart, your Zepto, and your Blinkit. Now, Blinkit was an acquisition they had done in the past, and people were very pissed off that you acquired someone that you knew, relative, etc. But guess what? It has actually turned around and it's doing extremely well because their GOV is growing more than 100% year on year, and new launches, they're into beauty, electronics, household appliances, toys is something that they've launched recently, and it's going berserk and everyone is doing well. Now, around 20% of the stores are operating at approximately 5% contribution margin, with newer stores are reaching break even in just 2 months, which is again giving a significant growth driver for that. Now, Blinkit is focused on increasing its density in the top 8 cities, which contribute to 90% of their gross order value, right? Obviously, they don't want to go to other places now because major revenue is coming from the same place. And also, Blinkit is nearing their adjusted EBITDA break-even growth. Now, adjusted EBITDA basically means it's not normal EBITDA. They take out ESOP expenses and they show profit. Now, is that good or is that bad? Only time will tell, but people in the market don't appreciate adjusted EBITDA. They want to see proper net profit growth, and that is something that these guys slightly do in the accounting standards, but they are on the track to make net profit growth. If you look at their other businesses, which is the dining out business or the Hyperpure business, Hyperpure is doing okay, it's not doing extremely great, and dining out business is doing really well right now, and I see a lot of people, a lot of offers coming out from these places as well. So these are some of the beautiful triggers that are kicking in with respect to Zomato. Now, another thing we always look at when we do research is investor con call. We need to understand what the management is thinking. So what the management has given, which is a guidance as they call it. So Zomato has basically given a guidance for adjusted revenue growth of approximately 50% year on year for the next few quarters, and most of the performance might come from the Blinkit business as well because that is doing really well. Now, food delivery business apparently was slightly below expectations in the previous quarter, but the company expects it to recover and start doing really well. But please understand, now we're going into the rainy season, so food delivery business might get hampered and might not do extremely well at that point as well. One thing that we should also look at is the antithesis. What happens if this doesn't play out? When will this story not do well? Now, this story is definitely looking very overvalued, and the price people are paying is a lot in Zomato. So any bad quarter or slightly bad quarter can see a stock price drop of minimum 15 to 20%. So that is something that is you have to be very careful. Now, the second thing is it was loss making at EBITDA levels. Just this quarter we saw a profit, and also it is adjusted profit, so we don't know exactly the real profit. It doesn't seem very likely that is there, but the market has gone ahead of it and said future mein growth hoga, so let us buy it. And also another problem is they're getting intense competition from players like Swiggy, Zepto. Now, Swiggy has also done a tie-up with IRCTC, which is going to give them heavy benefits, and we also saw that Swiggy is planning to come with their own IPO very soon. So Zomato would be a first good pick from the Indian consumption story to do well, but obviously we've looked at both sides, which is a thesis and antithesis. Now, before we go ahead with the video, let's thank the sponsor of today's video, who is Mstock. Now, Mstock is a trading platform by Mirae Asset Group. They have recently launched their 999 plan, which is also very unique. So here is the plan. Now, they also have another plan called the Zero Starting Plan, where only delivery mutual funds and IPO are free. So the 999 AMC is an optional plan where you don't have to pay AMC for lifetime if you opt it. So I would personally pick the one-time 999 plan plus the 999 AMC for lifetime access. Now, as you can see, either you can pay 1.2 lakhs worth of brokerage in a year or zero brokerage for life. Now, if you have to calculate your brokerage, let me check the option first, right? So in option, usually the brokerage is 20 rupees, right, per trade. And if I had to take an example of 10 lots of Nifty, which is around 150, then my total yearly saving comes to 7 lakh 68. But if I take just one lot of Nifty, that also is good enough because it saves approximately 1.2 lakhs of additional brokerage that I would have to pay, right? Same if you look at equity intraday, right? Again, it's 20 rupees per order, and even if you do 5 orders a day, you will still save 1 lakh rupees a year. Now, their M-Stock trading platform also has some key features such as one-click order execution, one-click order placement, voice search, and predefined index baskets, and a lot more. So definitely do check it out in the link in the description. Now, the second company we're going to look at is someone that's aggressively investing in the market, this entire group company, and that is called JSW Energy. Now, JSW Energy is focused on providing reliable, affordable, sustainable energy. Very simple, right? Now, by 2030, it aims to have approximately 20 gigawatt of generation capacity along with 40 gigawatt per hour of energy storage capacity as well. So they basically have a very good long-term vision that is going on in the company as well. So apart from just the energy business, or what you call it, green energy, they're also expanding into energy storage, and they've also expanded into green hydrogen production and solar module manufacturing. So it's not just creation of energy, but it's also some back-end integration that they're doing as well. And if you look at the green energy front, apparently JSW has recently contracted India's largest commercial scale plant with approximately 3,800 tons per annum capacity, which is expected to be ready by 2025. Now, financially, if you look at it, let's look at the financial triggers of JSW. It is currently trading at 52 PE at an 86,000 crore market cap. The last 1 year, as you see, it is growing. It is currently just breaching its all-time high. As you can see, it has just gone above its all-time high. And now this theme is just starting out because the whole energy stream is playing out right now. And if you look at the P ratio, yes, little on the higher side, definitely. But this is all assuming that the future growth is going to kick in with new plants, new contracts and all of that. They have been winning a lot of contracts in the past. They have been profitable as well. And if you look at the debt to equity ratio, their borrowings is 27,000 and reserves are 18, which is also a little high, but for power companies, this is very, very normal. And if you look at their cash flows, the cash flows also look very interesting and it looks positive. So that is again very good. And majorly everything is held by the promoter and the FIIs and DIIs. So public shareholding is very low at 8.53%, which again is a very strong motivation for companies to invest or DIIs to invest, because there's a very high chance that they will do well going forward, right? Now, what is the antithesis in this? The antithesis is that this sector has become hot. And by hot, I mean very, very, very hot. Everyone wants to be in green energy. Everyone wants to be in hydrogen. Reliance has come into hydrogen. JSW is into hydrogen. Tata is saying, I want to come into green energy as well. Adani is already playing out with this new plant that is coming out in green energy. So definitely the company is doing good. It has a brand value. It is bagging a lot of orders. But the problem is there are so many players in the market. A lot of influence is also going to kick in. So they might not get everything, and there might be a lot of breaking of the pie that people actually want to eat from this entire gigawatt story, right? Valuation is also high at 52. So I would say it needs to correct a little bit before any new investment can take place in this company. And another thing is they're doing capex, so any problem that happens in the capex will definitely become a big problem for this company. So that was the antithesis of this company. But energy is here to stay, so this is something that is going to do really well. There are a few companies in energy companies as well. If you want me to do a deep dive video into the energy space, comment below saying Shashank deep dive, or just comment energy below so I'll understand what it is. Okay, now the third company we're going to look at is a wealth management company. It is called Nuvama Wealth. Okay, so now this company is also very interesting. It is very similar to Anand Rathi, which is also there in the wealth management space. So they basically are into financial markets. They manage the money of ultra HNIs and HNIs in the space, 50 crores, 100 crores, 200 crores pockets. They do pre-IPO funds, crossover funds, AIF funds, Cat3 funds. Very, very interesting, right? Basically, they go by this metric called AUM, assets under management, or basically money under management. So if I have 100 crores that I'm using, 1,000 crores that I'm now putting into the market, they obviously get a nice split out of that. And if you look at the revenue split, wealth management business gives them approximately 65% return. That is also there. The company also has a strong customer base of more than 1 million HNIs, and their entire total client base, if you calculate, it's approximately 23,000 crores of capital that they have, and they also work with approximately 2,900 family offices. Now, coming to the growth drivers of this company. Now, wealth management in India is doing really well, right? You see everyone's coming into AMC business. Angel One has announced it's coming into AMC business. Grow has come into it. Zerodha has come into it. Now, these guys are also planning to come into their own AMC business because people are now heavily investing into mutual funds as well, mainly passive mutual funds. Now, if I had to go check Screener and check its fundamentals, it is currently trading at 31 with 16,000 crore market cap. Now, I don't know if 31 is good or bad because this is a very new space that has entered. So the time to analyze this business, which is not AMC technically, but wealth management, would take time. And if you look at its peer, who is Anand Rathi, this boss is trading at some other level only, right? Anand Rathi is trading at, I think, 60-70 PE, which is extremely high. But the stock price is doing well. The advantage of such companies, these type of companies, they're beautiful cash-rich companies, right? So if you look at the growth rate, 780 crores, 1384, 1778, 2223, 2836, and obviously operating at huge margins because isme kya hai? Mainly people cost is there, right? It's like IT, but much better than IT. It's managing people's money, so its people cost is very high, and you see they make good amount of moolah or money that comes into their bank account or in the pockets. So this is basically the company that they currently have. Their borrowings have also gone up, which is long-term borrowings of approximately 6,000 crores that has increased completely over here. So this is a very interesting company to keep an eye out for. Another company in the same space, I would say, is Anand Rathi, but the only thing is this guy is sitting at 73 PE, similar market cap, both of them, but this guy is trading at a higher PE. But if you look at his stock price, boom, 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 it's going up only, right? And if you look at the results, 1, 214, 275, 327, 216 COVID, obviously 408, 538, 655. Massive growth in revenues over the last few years and massive profit gain as well. Every year growth except COVID. And if you look at their money that drops into their pocket is also huge, right? Good amount of dividend payout is also kicking in over here. And if you look at the reserves and borrowings, it looks wonderful. Only negative part about this company again is the PE ratio, which is sitting at a very uncomfortable zone of 73. Again, there is no history about this wealth management business where I can actually tell you what is a good PE ratio or a bad PE ratio, but basically this is what it is, right? Now, if you look at antithesis, now number one is if there is a bad market tomorrow or if there's a recession based market, there's a very high chance that ultra HNIs or HNIs might move their funds out and go into a more illiquid space or more fixed income return kind of a thing. But that also, these guys are very smart. They say, okay, we have bonds, we have gold bonds, we have normal bonds, we have real estate bonds, you can invest there also. So once the money goes into these businesses, it doesn't usually come out very easily. And obviously they're facing very stiff competition from Anand Rathi as well, so he's also doing extremely well in this space. So guys, this was the 3 companies that I feel are going to trend in 2024. Obviously we'll keep a track of this. This is not a buy or sell recommendation, so please don't come tomorrow and tell me, Shashank, you told this company, I bought it and it's at 5% down. Anything can happen. That is why I talk about the good and bad things. Disclosure, I have not invested in this yet. I have invested them in the past, yes, but I have not invested in them right now. So please don't think about this as a buying or selling recommendation. This is only for your knowledge. Knowledge le lo, enjoy karo, have fun, learn together and live together, right? This is me, Shashank Udupi, signing off. Take care. See you guys. Bye bye.
Investments in securities markets are subject to market risks. Read all the related documents carefully before investing.